Welcome back to Talk Tickers. It is Saturday, January 24th, 2026. Today we are heading up to Boston to unpack the latest from Eastern Bankshares, ticker EBC.
Yeah.
And if you're watching the tape yesterday, you saw a textbook battle between, market psychology and the algorithms. It was a pretty wild session.
It really was. We saw that classic pop and drop. The earnings release hits, the algos see the headline beat, and boom, the stock spikes to 2205 in the pre-market.
Looked like a breakout.
It did. But then, the sun comes up, people actually read the transcript, and the air just hissed out of the balloon.
Hissed right out. By the close, EBC was down at $20.05. That's a fade of almost 6% from the highs.
A big fade.
So that's our mission for this deep dive. We've got the release, the investor deck, the transcript. We need to figure out why. Was this just profit-taking after a huge 17% run-up? Or is there, a structural problem hiding in the fine print?
Well, I think it's a conflict between two narratives, really. On one hand, you have management promising these massive capital returns. I mean, basically putting a floor under the stock.
Right.
But on the other hand, you've got a balance sheet that's looking a little messy after the merger and guidance that is, let's be honest, pretty chilly.
Okay, so let's strip away the PR fluff and start with the numbers, the ones that trick the algorithms at 8 a.m. Run us through that results snapshot.
Okay, so on the surface, it looked like a victory lap. For Q4 2025, Eastern reported GAAP earnings per share of 46 cents.
And consensus was?
Consensus was only 41 cents, so a clean beat. Even on an operating basis, they hit 44 cents. So bottom line, they delivered.
And usually in regional banking, a clean beat like that gets you a nice green day. But the top line, the revenue, that's where things get a little more complicated.
That is exactly where the first crack appeared. Revenue came in at $283.5 million. The consensus was $285.
So a miss of $1.5 million. Doesn't sound like a disaster.
It's not a disaster, but in this market, investors are just hypersensitive to the quality of the earnings.
Because if you beat on profit but miss on sales,
yeah,
it suggests you're maybe cutting costs or relying on one-time things, not actually growing the business.
Exactly. The engine isn't revving as hard as the dashboard says. Now, the flip side is that net interest income, the NII, was massive. $215.8 million, up 43% year over year.
43%.
And the net interest margin, the NI, expanded to 3.09%. That's up 37 basis points. On paper, that looks like a growth explosion.
But we have to put that in context. That jump isn't just organic growth. It's mostly the HarborOne acquisition, right? They just bolted on a whole new balance sheet.
That's the story. So we need to put a pin in how they got to that margin. I think there's some accounting magic in there. We'll get to slide 18 later.
Okay, slide 18. Got it.
But before we get into the accounting weeds, let's talk about their cash, their capital. This sets up the biggest strategic pivot of the entire call.
The capital ratios, how are they looking?
They are just swimming in capital. The Common Equity Tier 1 ratio, CET1, ended at 10.96%.
Okay, so for everyone listening, think of CET1 as the bank's airbag. Regulators want it big, but investors don't want it so big it takes up the whole car. 10.96% is a very thick airbag.
It's arguably too safe. It's inefficient capital, and management knows it. And that brings us to the moment on the call that really signaled a regime change at Eastern.
It was so explicit. The executive chair, Bob Rivers, and CEO Dennis Sheehan, they just came out and said, quote, "We will not pursue any acquisitions, full stop."
No wiggle room there.
None. They're done building the empire. Now they're in optimization mode.
Which is a huge shift. I mean, Eastern's DNA for years has been M&A. They rolled up Century, Cambridge, HarborOne. They were the Pac-Man of New England banking.
And now they're saying, we're full. It changes the whole investment thesis.
It completely changes them from a growth stock into a value extraction stock. And this is where the bull case gets interesting. If you're not spending that capital pile on buying other banks,
you have to spend it on yourself.
Precisely. This is what you love to call the capital cannibalism thesis.
Yeah.
They are turning that firepower on their own stock. In Q4 alone, they bought back 3.1 million shares. That's 26% of their entire authorization in just 3 months.
That's an aggressive pace.
Yeah.
That tells you they are price insensitive. They're not timing the market. They're just hitting the bid every day.
And they're not stopping. They said they'll burn through the rest of the authorization by mid-2026. The math is simple. They want to manage their CET1 down. They have, as you said, a license to incinerate shares.
Which puts a floor under the EPS. Even if the bank itself doesn't grow, and we'll get to that in a second, if you shrink the share count by 8%, your EPS goes up. You're manufacturing growth by eating your own stock.
It's a valid defensive strategy. It's why the stock has held up as well as it has. But you can only financially engineer your way to prosperity for so long. Eventually, you have to actually make loans.
And this is where the call got messy.
This is where it got messy. The credit numbers had a bit of a hangover. This is probably what spooked the market. Non-performing loans, NPLs, they increased by $13 million in the quarter.
And in regional banking, seeing NPLs tick up is like seeing a cockroach in the kitchen. You just assume there are 50 more in the walls. Where did these bad loans come from?
The CFO, David Orzeto, he was very quick to point the finger. He said this was entirely from loans they acquired from HarborOne, $94 million in total acquired NPLs.
Okay.
He called it a handful of large commercial real estate loans and one C&I loan.
So the defense is, hey, we didn't write these bad loans. We bought them, and we knew they were bad when we did the deal.
That was the line, exactly. They said it was spot on with their due diligence and that they have a 35% reserve coverage on these specific loans. They're telling investors, don't panic, we marked these down already.
But the market panicked anyway. Why? If management says it's under control, why the sell-off?
Because credit noise is contagious. You know, even if management says we knew, investors just hear commercial real estate and bad loans and they get nervous. You start wondering if that credit mark was aggressive enough.
It introduces uncertainty.
Yeah.
And nobody wants uncertainty around office loans right now. Okay, let's circle back to that accounting magic. You flagged slide 18 in the deck. Why is that slide so important?
Slide 18 explains why that 3.09% margin might be, well, a bit of a mirage. A huge chunk of their income right now is something called accretion of discount.
Okay, break this down for us. Explain accretion of discount like I'm 5.
Right. So imagine you buy a loan that's supposed to pay back $100, but because it's a little risky or rates have gone up, you only pay $90 for it.
Okay, got it.
Over the life of that loan, as it gets closer to paying off, you get to recognize that $10 difference as income.
So it looks like interest income on the P&L,
Yeah.
but it's not new cash coming in from the borrower. It's just the accounting of the purchase price, closing the gap to par value.
Exactly. It's a paper profit in a sense. And in this quarter, that accretion was $22.6 million. That is a massive number. It was a huge driver of that margin expansion.
So if you're a serious investor, you have to strip that number out to see what the bank is actually earning from its core lending business.
Yeah.
Because that income stream is a melting ice cube. It goes away.
Correct. And if you strip it out, the core margin is much, much lower. And this is why that revenue miss matters so much. The core engine isn't producing the power the headline number suggests. The beat was juiced by the merger math.
That's the key insight. The cannibal buyback supports the stock, but the core banking engine is sputtering. Which brings us to the guidance. The CEO, Dennis Sheehan, dropped a quote that I think is going to haunt this stock.
Oh, yeah.
He called Q1 loan growth a frozen tundra.
Frozen tundra. You never want to hear your CEO compare your growth prospects to a barren wasteland. I mean, to be fair, he was talking about seasonality. Q1 is always slow.
But it still signals a very slow start to 2026. Their full-year loan growth guidance is only 3 to 5%.
Which is barely keeping pace with inflation. But here's the part of the guidance that worries me more.
The deposit growth.
The deposit growth, projected at only 1 to 2%.
You spotted the gap. If loans grow at 5% and your deposits only grow at 1%, you have a funding gap. You have to find that cash somewhere else.
And that somewhere else is expensive. It means borrowing, it means paying up for deposits, and that hurts your margins.
So what are their rate assumptions?
The CFO is modeling in 2 rate cuts for 2026, June and September, which is pretty standard, but it's a risk. If the Fed stays higher for longer, that funding gap becomes a lot more painful.
So their whole guidance is built on a Goldilocks soft landing scenario. If the yield curve stays inverted, that NIM guidance of 365 to 375 looks optimistic.
Very optimistic. There was one bright spot, though.
Let's hear it. Any warmth in the tundra?
Wealth management. Assets hit a record $10.1 billion. And fee income is great. It's capital light, it helps stabilize things, but it's not big enough to carry the whole bank yet.
So let's put it all together. The stock was up 17% in a year, crushing the index. The market priced in a perfect merger. Instead, they got a frozen tundra, credit headaches, and an accounting-fueled beat.
That is the definition of sell the news. At $22 a share, you are paying for perfection. When the CEO talks about a slow start, the market realizes the easy money's been made.
So it feels like a trade-off. You're swapping growth potential for capital return certainty. You're not buying Eastern for growth anymore. You're buying it because they're going to buy back 8% of the company.
It's a defensive safety play now, which for growth investors is a signal to exit. But for income investors, maybe at $20, it starts to look interesting again.
All right, so how do we play this? It's time for everyone's favorite segment. The legal team is currently sweating, but we're going to do it.
The standard disclaimer.
This is not financial advice. We are just two voices in your headphones. Do your own homework. Don't sue us.
Yeah.
But if we were going to build a trade around this frozen tundra dynamic, what does it look like?
I think you have one in mind.
I do. I'm calling it the Beantown buyback straddle.
Here's the logic. You have two forces. Force one, management has to buy stock to lower their capital. They are a price-insensitive buyer. That creates a hard floor.
Agreed. They're the ultimate backstop.
Force two, the frozen tundra. There is no catalyst to drive this stock to $25 or $26. Loan growth is dead. So you have a floor and you have a ceiling.
So you play the range.
Exactly. You go long EBC equity to catch the dividend and the buyback support. But at the same time, you short the 2250 calls. You sell that upside volatility. You collect the premium from people who think it's going to the moon. When the CEO just told you it's freezing outside, that makes a lot of sense. You clip the coupon, clip the option premium, while the CFO is busy buying up the float. It's a yield enhancement play on a sideways stock. But I have an even more aggressive kicker for you.
Let's hear it.
The long EBC short KRE pair trade.
Ah, betting against the whole sector. Explain that logic.
Well, Eastern has a specific catalyst the rest of the sector doesn't. The cannibal buyback. Most other regional banks in the KRE index do not have an 11% CET1 ratio. They don't have the cash for aggressive buybacks.
They're still struggling with deposit costs and CRE fears, but without Eastern's big capital buffer.
Exactly. So you're betting that Eastern's specific ability to eat its own shares will let it outperform the generic index, even if the whole sector trades down. You hedge out the macro risk and capture the alpha from the buyback.
That's a sophisticated play. It isolates the one thing they have going for them.
Just remember to check the footnotes on slide 18 before you do anything. You have to watch that accretion number. If that fades faster than organic growth kicks in, that floor might be lower than we think.
Always read the footnotes. So to wrap this, strong EPS, but it was helped by merger math. A massive buyback that puts a floor under the stock, but a warning of a very slow start to the year.
Management is betting the house that organic growth will eventually kick in. But for now, they're using the checkbook to keep the stock afloat. Q1 is the big test.
Here's a final thought. If Eastern and other banks like them are really done with M&A, if they all switch to this cannibal buyback mode, who's left to buy the struggling smaller banks?
That's a good question.
If the big buyers go on strike, we could see a massive repricing in the valuations of the entire small-cap banking sector. The exit strategy for the little guys might have just evaporated.
That's a sobering thought for the industry. The consolidation wave might be hitting a wall.
Something to watch. Tuck Tickers signing off. Good luck out there.